Have you ever wondered how a slight shift in natural gas prices can trigger lasting effects across our economy? It's like discovering a powerful yet often unnoticed force at work. In today's journey, we're sailing through the intricate waters of inflation. We focus on the subtle yet significant interplay between natural gas and oil prices and their profound effects on inflation and industrial production. What embarked us on this exploratory odyssey? A compelling research paper titled Natural Gas and the Macroeconomy, Not All Energy Shocks Are Alike, authored by Piergiorgio Alessandri and Andrea Gazzani, casts a new light on this topic. By the end of our session, you'll understand the extent of these vital supply shocks on industrial production and inflation, and explore the potential future landscapes they might shape. I'm Marcel Debus. Welcome to Marcel's Markets. Los geht's! Our main topic today zeroes in on inflation's roots, but first let's lay the groundwork. Picture inflation as a two-headed beast. It's crucial to distinguish between its sources. The first head we're dealing with is demand-push inflation. This one's a familiar face in economic landscapes. Why? It's all about balance, or the lack thereof. When an economy outpaces its resources, it's like a sprinter running too fast without enough track. The result? Prices surge. How do central banks counter this? Their go-to move is monetary tightening, often hiking up interest rates. Central banks today mostly dance to the tune of inflation targeting. Take the Fed and the ECB, for instance. They aim for a 2% inflation sweet spot over the long haul. When inflation strays from this narrow path, these financial maestros step in, often tapping the brakes on economic growth. However, there's a catch. Timing is everything. As we witnessed in 2022, inflation has already gate crashed if the central bank is late to the party. Plus, there's a lag. The impact of hiking interest rates doesn't hit the real economy for several quarters. It's a delicate balancing act, one that requires precision and foresight. Navigating back to our inflation target range isn't a sprint. It's more of a marathon, taking several quarters. Meanwhile, our wallets feel the pinch. As inflation lingers, the purchasing power of our money dips and prices climb. Interestingly, central banks in the past used strategies tied directly to the price level. However, the shift to inflation targeting has its downsides, especially from the perspective of consumers and investors. Even when inflation steadies back to that 2% band, the price level doesn't rewind to its starting point. It's like a ratchet effect, easy to crank up, but not so simple to rewind down. Let's come back to our central theme. We've already talked about demand-driven inflation, which is quite common. But here's the second head of the two-headed beast. This is the supply-side inflation. This happens when vital natural resources become scarce, driving up prices. Oil is a usual suspect, but natural gas has recently been spotlighted. When supply tightens, prices inevitably soar. The year 2022 provided fresh examples with gas, but we need to rewind the clock back to the 1970s and 1980s for oil price shocks. Those were times marked by geopolitical tensions, like the Yom Kippur War, an Israeli-Arab conflict that significantly impacted global oil markets. The Arab oil embargo of the 1970s is a classic example of supply shock, as Arab countries ceased oil exports to the West. This led to a dramatic spike in oil prices, which is evident in the graph we're looking at. Fast forward to recent times, and we see history echoing in a different key. The Russian-Ukrainian conflict has triggered similar disruptions, but this time with natural gas supply. Various factors, including manipulations and geopolitical tensions, have catapulted natural gas prices from under 30 euros to soaring above 300 euros. Both instances are tales of supply shocks, albeit for different commodities and eras, yet their economic ripples are remarkably similar. In the grand scheme of things, supply shocks are less frequent. Here's the crux. Monetary policy tools aren't equipped to tackle oil and gas price spikes directly. That's the tricky part about supply shocks. This is acknowledged by Fed officials. But don't think we're out of options. Economic policymakers have tried various tactics, like price freezes. A case in point is the United States in 1973 under Nixon. However, this approach to capping oil prices didn't quite hit the mark. Fast forward to Hungary in 2021, and history repeated itself. Despite initial efforts, the price freeze had to be rolled back after about a year, mainly due to resulting shortages. It's a complex jigsaw puzzle where solutions aren't always straightforward. Let's break this down with some basic economics. Picture the classic supply-demand curve. If you set a price cap, a ceiling where prices can't climb any higher, here's what happens. Demand stays high while supply dwindles. It's a recipe for shortages. Just look at the curve. The supply volume, Q1, is lower than the demand volume, Q2. It's not an if, but a when situation. Real-life economics isn't as simple as drawing two lines on a chart. The economy doesn't just snap to a new state overnight. It's a slow shift, often taking many months, sometimes even a year, to fully adjust. This lag time is crucial in understanding the real-world impact of these economic policies. To visualize this, imagine a yellow zone on a graph. This represents the deadweight loss, a kind of economic inefficiency where society bears the cost. In an ideal world, goods are produced optimally, but deadweight loss emerges when they aren't, like in our Hungarian example. Picture the scene: long queues at petrol stations, having to visit multiple stations to fill up, and countless hours wasted. For entrepreneurs, it spells unpredictability in the business environment. These are the scenarios where deadweight losses pile up, ultimately chipping away at the future economic output. It's a vivid illustration of the unseen costs of monetary policies. Let's swing back to our main subject, inflation. We've delved into two types, inflation from demand and from supply pressures. Here's a key point. It's not black and white. For example, the current inflation rate is 3.2%. You can't say this is caused by only demand or supply factors. It's usually a mix. Part of that inflation could stem from supply shocks, while another chunk might be due to demand pressure. Of the two, demand pressure inflation is more common, and something central banks typically have tools to handle. However, supply shocks are a different beast. As I've mentioned, they are not something monetary policy can easily tackle. Even the solutions economic policymakers come up with tend to be temporary fixes at best. It highlights the nuanced and complex nature of managing inflation in a dynamic economy. Let's focus on some specifics, the rooks or critical points in this scenario. Take a look at these two enlarged graphs. On the left, we have a graph marked with TTF, showing the change in natural gas prices. On the right, there's another graph depicting the impact of oil price changes and shocks. Focusing on the left graph, we first break down the TTF natural gas price shock month by month. You'll see a clear depiction of the price surge, stretching from 0 to 15 months. This visual breakdown helps us understand the timing and magnitude of these price shocks in a more detailed and digestible way. Analyzing core inflation reveals a notable trend. A spike in natural gas prices typically takes 18 to 24 months to fully integrate into core inflation figures. If we project this onto our chart, we hit the inflation peak around 16 months after the initial price hike. The data further suggests that the ripple effects of these price increases take 4 years to phase out from the inflation statistics. This means a single surge in natural gas prices can influence 4-year inflation figures. It's a profound insight into the long-term impact of such price fluctuations on the economy's inflationary trends. Let's delve into the red curve on our graph, which represents an average. While the confidence interval around it is broad, it closely aligns with the average, allowing us to deduce the general trend of events. Now, shifting our focus to industrial production, the graph clearly shows that changes in natural gas prices negatively impact industrial production. This adverse effect is more enduring than other variables. Even at the end of the observed period, industrial production remains in a downturn. From this analysis, we can draw a critical conclusion. On average, a 5% increase in natural gas prices adds about 0.2% to the peak of core inflation and contributes to a significant 0.6% decrease in industrial production. These figures underscore the substantial influence of natural gas price fluctuations on broader economic indicators. As our graphs illustrate, the connections between natural gas prices, inflation, and industrial production are evident and compelling. For inflation, there's a positive correlation with natural gas prices. As natural gas prices rise, so does inflation. Conversely, the relationship with industrial production is negative. Higher natural gas prices lead to a downturn in this sector. Now, shifting our gaze to the oil graph, we observe another intriguing pattern. The price of oil is a factor in the energy component of the price index and core inflation. However, the impact on inflation is more immediate compared to natural gas. Here, the graph shows that inflation peaks around the 10-month mark. This quicker response regarding oil prices adds another layer to our understanding of how different energy sources uniquely influence economic indicators. The influence of oil prices on inflation is swift and fleeting, as our graphs show. Oil price hikes are absorbed and then priced out of the market more rapidly than natural gas price increases. Similarly, when oil prices rise, there's a negative correlation with industrial production. However, there are crucial details in these graphs that might take time to be noticeable. Although oil and natural gas prices affect inflation, the impact isn't equal. A unit increase in oil prices has only half the effect on inflation compared to the same increase in natural gas prices. This means that natural gas price hikes have a much more potent effect on inflation, doubling the impact of an equivalent rise in oil prices. It's a significant distinction, highlighting the disproportionate influence of natural gas on inflationary trends. In summary, the increase in gas prices plays a crucial role, impacting both industrial production and inflation significantly. This underscores why it's particularly concerning that European countries have pegged their natural gas price purchases to the Dutch TTF natural gas price. The TTF market, while being a benchmark, is relatively small in volume compared to the total gas consumption of European countries. This disparity is vital because in markets where volumes and turnover are low, like the TTF, susceptibility to manipulation is higher. Therefore, aligning with such a market can lead to disproportionate and potentially distorted impacts on natural gas prices, echoing through these countries' economies regarding industrial production and inflation. Recent legislative changes have significantly calmed the storm we faced, with Dutch TTF-related natural gas pricing in 2021 substantially lowering the risk of similar events. However, it's essential to understand that future fluctuations in natural gas and oil prices will continue to have a marked impact on inflation, generally pushing it upwards. It's important to note that the effect of natural gas prices is particularly significant, leading to a noticeable downside, an apparent decrease in industrial production. This is not a short-lived trend. It's a robust, long-standing pattern, emphasized by years of data and central to the research paper we've discussed today. One thing has become abundantly clear throughout our exploration of the complex landscape of inflation, natural gas prices, and industrial production. Our economy is a richly woven, enthralling tapestry. Suppose this deep dive into the nuances of economics has intrigued you and you're keen to keep up with the ever-evolving world of economics and investments. In that case, I'd be grateful for a small favor. Please press the subscribe button. In our next episode, we'll confront another pressing economic issue, the impact of wars on stock markets. If there are any questions or specific areas you're curious about, don't hesitate to leave them in the comments. I'm Marcel Dibus. Thank you for tuning in. Successful trading and goodbye.